Assalamu alaikum friends, welcome to day 10 of AFM revision crash course. Today's topic is hedging foreign exchange risk. So we are going to cover all the types of hedging instruments in this video relating to foreign exchange. Interest rate we'll be covering in the next video. Past exam history, then we have hedging, forward contract, money market hedging, future, options, swap. There are two types of swap. One is forex, one is currency swap. And then we have bilateral and multilateral netting and matching agreement. Forward, money market, future, options, and swap. All these are external hedging techniques. The last one, which is bilateral and multilateral netting, this is internal hedging techniques. Okay, you should always start with internal hedging whenever you can, and then you have to go to the external hedging techniques. So now let us go to the past exam history. If you see the overall, this question, the foreign exchange risk, mostly comes in question number 1, if you have seen, right? Because every year we can see question number 111. Wherever it is written question number 4, this was before September 2018, right? Because it was P4 that time. That time you had 4 questions. Out of 4, you had to do 3. Okay, you had an optional questions, but no more in AFM. So we only have 3 questions, 1, 2, and 3. And if you see, mostly it is in question number 1, right? Whether it is September 2018, just check the last 2 years, September 2019 and December 2019. It came in question number 1, that means 50 marks question, 50 marks. Whether it is about netting and matching, whether it is about forward, whether it is about money market, whether it is about option, future, all this question came in question number 1. Okay, and if you see currency swap didn't come till now, that does not mean that it will never come. You never know, that you might be that batch, the September 2021 I'm talking about, where you might get currency swap, even though it has not been asked in the past. So the only area that you can study currency swap is from your textbook. Okay, now let us go to the hedging. In my previous video, which was day 9, I have covered what is hedging, definitions of hedging and all. So hedging means, hedging can be broken down into 2 things. Okay, but before hedging means you are minimizing the risk, you are eliminating or you are reducing the risk. So the foreign exchange risk can be divided into 3 categories. Number 1, transaction. Number 2, translation. Number 3, economic risk, or you could say exposure. Is the same thing. Transaction risk, that is the area that we are going to cover in this video. Transaction risk, that means when you are dealing with overseas and when you have to convert the currencies back to your home currency, due to the foreign exchange movement, you will be incurring some risk. Some risk is there. Either it might go in your favor, either the exchange rate might go unfavorable, right? So you never know, it's a risk. It can go upward, it can go downward also. And if it's a payment, your payment might become more expensive now, or your receipt might become less now because of the movement in the foreign exchange. So that is known as transaction risk or transaction exposure. This type of risk we can hedge using hedging instruments like options, swap, future, forward. Coming to the next type of risk. Okay, remember, you can be asked questions from this area also, because foreign exchange risk is not only about calculating numbers. You will not only be asked whether you get it as a 50 marks and 25 marks. Okay, you will be asked a theory question. Okay, it could be from any area. It could be from your treasury department. They might say the advantages of centralized versus decentralized treasury department. That's one area. Second area, they might ask you about whether to hedge or not to hedge. Third area, what type of risk is it? Transaction, translation, economic risk, and how to hedge it. So that's another area. Okay. Translation, that second type of risk. Okay. When you translate the foreign subsidiaries financial statements in your home currency. Okay, because their financial statement is prepared in their currency, in foreign currency. Now you have to transfer it to your home currency. Remember, if it's a parent, if it's a group of companies, everything has to be translated to the parent company's currency only before you consolidate. You cannot consolidate in foreign currency and your one in your currency. No. So there's a risk. It might be a gain or a loss, but there's a risk is there, right? So that is known as translation risk. So For translation risk, even if you're not involved in any foreign this thing, you're not doing any selling or buying or any transactions with them, but having that foreign subsidiary, you have to translate at the end. So there's a risk. Economic exposure. This risk is for the long term risk. Okay, and this risk usually you cannot hedge using hedging instruments. Economic risk is, for example, the competitiveness of your currency went down. Okay, the government, the policy that government has implemented is not good for the company. Sorry for the country. So because of that, this all are having a negative impact on your currency, right? On your value of your currency. So that is known as economic exposure, and usually this stays for a long term. Especially you must have seen in developing countries or underdeveloped countries, the value of the currency is not so strong. See, it's not so stable. The reason is because the political environment is not stable over there. So all these are having an effect on your risk, that which is known as economic risk, and this are usually for long term, for 4 years, 5 years. This is not that today there's a risk, tomorrow it will change. No, this risk are long term. It has a long term impact. It's not for the short term. Other two, okay, transaction and translation, you still can hedge up to some level. Economic risk is not like that. Okay, so these are the few differences between this three type of risk. In case if the question asks you to differentiate between these three type of risk, or the question might ask you what type of risk is it in the case given to you. So you have to be prepared to talk about this. Okay, more about this you can read from your textbook. Now let us go to the definition of hedging. Hedging means you are taking measures. You're not leaving it just like that only. You have the risk and you are just bearing the risk. No, you are taking some actions in order to reduce that risk or eliminate that risk completely. That is known as hedging. It is known as hedging the risk or hedging the exposure. There are two broad types of hedging, remember. That means you can reduce this risk internally as well or externally. So for internal method, first let us go through the internal methods. Internal methods are invoicing in home currency. Yes, if you are invoicing the foreign subsidiaries transactions in your home currency, then there is no risk of converting it using exchange rate, right? Because it's in your home currency, there is no risk. The foreign risk went. So you can invoice in home currency. These are internal method. Internally, you can do it. Second, leading and lagging. Leading means you are paying in advance. You are doing your transaction in advance. For example, if you have to do a payment or a receipt, depending on the exchange rate. If you know that exchange rates are going to go up, that means if you are having a foreign payment, you have to make more payment later. So you will be making the payment now at this rate because the transaction is the rate is lower. So that means you have to make a lower payment now rather than waiting for 2 months when the exchange rate will go up. So you are leading the payment. Leading means you are paying in advance because you know exchange rates in future will go. It's going to be unfavorable. Your cost will go up. Your payment will increase. Lagging is the opposite of it. You are delaying the payment because you know exchange rates will become favorable. And how do you know whether it will become favorable or not? Because we don't know about the future. That's a good question to ask. It will be given in the scenario. They will tell you idea whether it will be increasing or decreasing or what's happening to the scenario of the exchange rate movements and all. So based on that, you have to decide whether leading or lagging. Okay. Then matching. Matching means what? You are matching your payment with the receipt. If you're having a receipt from a foreign subsidiary in one currency, make sure that you're doing a payment also. For example, you can take a borrowing. When you want to take a borrowing for a loan, you can take in that currency, the same currency as your receipt, so that you don't have to deal with two different exchange rates. Because exchange rates for two different currencies will be different, no? So that risk is minimized. Now, let us go to the external methods. Our main focus is on external methods. But internal method also can be asked alongside the external method. For example, mostly the netting of your receipt and the payment. Okay, that is called as matching. So external methods are, you are very well aware of it: forward contract, money market, currency future, currency option, currency swap. Okay, now don't get confused this with the internet interest rate risk management, because those are different to this. Not totally different, but some differences are there. Some little differences are there, because in currency you have to deal with two currency. Interest rate is only one rate, so that's one advantage in interest rate. But usually, from my experience, let me tell you this, students perform better in foreign risk, foreign exchange risk compared to interest rate risk. Okay, but that does not mean that you have to always prepare or do questions on foreign exchange risk and leave interest rate risk aside. No, you have to do both. You might get both together in one question as a 50-mark question. You never know. Okay, so be prepared for both. So in interest rate risk, we have all the same options there except one, which is money market hedge. Money market hedge we only have for currency rate risk, not interest rate. Okay, that's only different. It's just all the same, because in currency option also we have to calculate premium. In interest rate option also we have to calculate premium. Here also we have to decide buy or put. There also we have to decide buy or put. Here also we have to calculate the gain or loss. There also we have to calculate the gain or loss. So these are similar. The nature works like that. If you are good in foreign exchange risk, the external methods, options, currency options, you will be good in interest rate future also. If you are good in currency options, you will be good in interest rate options also. If you are good in currency swap, okay, interest rate swap is different, of course, but yeah, you will be good. It's it's a definite, right? Definitely, there's no doubt, because it goes very similar, except few differences. Okay, the differences are very little, so you don't have to worry that this is totally different or something. No. So make sure that when you're studying, you study from the foreign exchange risk first, and then you go to interest rate risk, because then things become much easier. Because to be honest, interest rate risk is little tougher than exchange rate risk, because more working is required there for interest rate risk. Okay. Now let us go to forward contract. This is the easiest out of all. Okay. What is forward contract? So the definition of forward contract, usually you don't have to know, but just for the basic understanding, in case if someone wants to know what's given, it is the fixed rate. This is a rate which is fixed. You are going to pay or receive at this date only. At the future, okay, the date is decided, the rate is decided. One rate only. So using that rate, you convert to your home currency. That's it. In forward, you only have to do that. They will give you the rate, you have to pick up the correct rate, and then using that rate convert to your currency, from foreign currency to your currency, your local currency. But the main thing in forward is, the only difficulty is which rate to pick. You will be given two rates, ask and bid price. Which rate to choose? If you are good in that, forward is nothing for you. You only have to do that one thing, choosing the rate for forward. Okay. And sometimes, okay, they might not give you forward. You have to remember this. Not always forward will be given. Sometimes they might not give you the forward rate. So if they don't give you the forward rate, don't try to calculate or search for forward in the question and waste time thinking that, oh, I have been doing in the past paper forward, so here also I'll be having forward. Where is the forward? You're looking for the forward rate, but you're not getting anywhere. If it's not there, if it's not mentioned as forward rate, don't, it's not there. Then you have to go to the next hedging technique, which is there. It could be options or futures only, no forward. Or it could be just forward and option only, no future. So it's like that, okay? But this is the most common form of hedging, okay? Sometimes the market does not exist at all. Market does not exist at all means it depends. In the question they will give you the forward, but mostly it's given, okay? That's how we have been doing in the past papers also up until now. They give forward usually. That is the first thing that we calculate also. Using forward, because this is the simplest and the easiest to understand, also to calculate also. Now, advantages and disadvantages of each hedging techniques you need to know. You need to know whether it is forward, whether it is future, whether it is option, whether it is swap. Because when you're giving a recommendation, okay, after calculating and all, which hedging technique is the best, you have to recommend, right? That's the question. That time you have to use this advantages and disadvantages only, and don't give 5 6 advantages or 3 no, one or two advantage and disadvantage is enough. Okay. So advantages, number one, OTC. What is OTC? Over the counter. Over the counter means it is customized. That means it can exactly match what you have been trying to hedge. For example, if you want to hedge 2000 only, you can take a forward for $2000, but the same thing you cannot do under options of future, because there it's limited. The contract size is limited, standard for future, because it is exchange traded. It is traded on the market, futures and options. But Forward is not like that. Forward is over the counter. It is not traded on this exchange. It is, you want it, you go for it, ask for it, you get it over the counter. Okay, that's an advantage. Second, simple and easy to understand. We all agree by that, right? Isn't it? Simple and easy to understand. Disadvantages. Availability, see above. That means what I've given on the left side, the second bullet point, that market sometimes does not exist for forward, because since it's over the counter, it might exist, it might not exist, so availability is not there all the time. So that's a disadvantage. Second, binding contract. This is very important. Make sure that this disadvantage you mention in your answer, that it's a binding contract. Okay, that means you have to pay. Okay, even if the commercial circumstances changes, you will be known as customer that is paying late, because you have that obligation to pay. It's a binding contract. Contract binds you to pay or receive whatever the currency on that date. Next, eliminates exposure to upside as well as downside movements. What does it mean? Forward is only one rate. It's true that if the exchange rate goes unfavorable, it will protect you from the risk. But what about if it's the other way around? What if your prediction is wrong and exchange rate goes in your favor only? Then same way, risk is minimized, eliminated. Same way, gain is also eliminated. You cannot take the advantage of that gain also if the exchange rate goes in your favor. So you will be eliminated from that gain also. You cannot take the advantage of that gain, because you will be fixed at the one rate only. Now let us go to money market hedge. Money market hedge, students find it often difficult to decide on the investing rate and the borrowing rate. So I thought of making this table to make things very easy and clear cut. Because money market hedging we often don't get, but there are times it's like, how do I say, 40% to 50% we get. But mostly it is options, futures, and forward when it comes to currency rate risk management. Okay, so in the money market hedge, the question that you need to ask, whether it's a payment or a receipt, future foreign currency cash flow, whether it's a payment or whether it's a receipt, this is the question that you need to ask. Whether it's a foreign payment or foreign receipt. Why? Because then the treatment changes. The main thing in money market hedging you need to remember is at which rate to invest, at which rate to borrow. That's it. That's it. If you understood this thing very well, money market hedging is nothing for you. This is also very easy. So this table, memorize it, keep it ready. This will help you. Nothing else you need to know about money market hedging, only this table you follow, that's it. Let us first start with the payment. Receipt is the opposite of the payment, okay? Payment. So if it's payment, three things you need to do in this order only. First, invest in foreign currency. Usually, technically, if you see, we borrow first, no? After we borrow, we convert, then only we invest. But no. For when you're calculating, I'm talking from your calculation point of view. Forget about what's practical and all. Okay, so you memorize this like this only. Invest in foreign currency. Why? How do you decide you invest in borrow? See, always see what is the currency that you are given at. Whether it's a payment, whether it's a receipt. You will always be given the foreign currency, isn't it? You will not be given your home currency. You will be given the foreign currency only that you have to convert to local currency. That means your home currency. Whether it's a payment, it will be a foreign payment. Whether it's a receipt, it will be a foreign receipt. So whatever you do, whether invest or borrowing, you have to start with your foreign currency. Because how will you know the home currency? Unless you convert it, right? So before that conversion, you have to know what are you going to do with that foreign currency. Whether payment or whether receipt does not matter. So if it's a payment, remember for one thing properly. Remember the table for the payment, you will automatically know for the receipt is just the opposite of payment. That's the easiest way to remember things. Rather than learning two things and getting confused and putting this thing over here, receipt for payment and payment for receipt. It should not be like that. Because I have seen students making the silly mistakes also. In spite of me repeating that just memorize for payment or just memorize for receipt, just memorize for one thing properly. The other thing is just the opposite. So for example, if you are given a receipt, but you have been memorized for payment, you know that for payment, invest in foreign currency. So you can quickly tell that borrow in foreign currency for receipt. Isn't it very simple? Just opposite. Okay. Even if you are studying for payment, receipt comes, it's okay. You know, it's the opposite of payment is also receipt. So first you invest in foreign currency. Okay. That is the investing rate. So for foreign currency, you have to use the investing rate if it's a payment. Second, the second step is common for both receipt and payment. Convert to home currency using what rate? Spot rate. In the forward rate, we used forward rate to convert. But here in money market, our focus is not about the rate. Which rate are we taking? Our focus is about the interest rate, the investing rate or borrowing rate. That is our focus. Hence, it is called as money market. So we are focused about money, investing and borrowing, and investing rate and borrowing rate. This is not about the rate. So spot rate, because we don't have a separate rate called as money market rate. How we had for forward rate or future rate or option exercise price for option rate. We don't have like this for money market hedge. Okay, so money market hedge convert using spot rate. Whether it's a receipt or a payment, you have to do this conversion in the second step. Third step, borrow in home currency. You see the third and the first step. First is the opposite of third. First one you invest, definitely you have to borrow in some currency. You invest in one currency, you borrow in another currency. It should be like that only. You cannot invest and borrow in same currency. Come on. I mean, otherwise, why would they give you two currency? So you invest in foreign currency and you borrow in what currency? Home currency. Okay. But technically, if you say practically, we normally don't follow this step. How can we invest without borrowing? We first borrow in our home currency, then we convert. Okay. No need to convert because foreign currency is already there, then we invest. Right? But if we are given the home currency, then it's easy. We borrow in home currency, convert into foreign currency, then invest in foreign currency. But in exam, you will be given with the foreign currency. So you invest in that, convert home currency, then borrow in home currency. Okay. Coming with the receipt, opposite. Payment, we were investing in foreign currency. So receipt, I told you start with foreign currency in both. So you borrow in foreign currency, borrowing rate. Second step is similar. Third, invest in home currency. Okay, the order changed, that's it. The order changed. Very important thing you should never forget after this table. In fact, while using investing rate and borrowing rate, this thing you should remember. Do not forget, I have written it capital letter in bold letter so that you never forget this. Because students forget this. After telling them hundred of times not to make this mistake, they still do this mistake. What is that mistake? Whatever the rate, investing rate or borrowing rate is given on that table to you, they take it straight away. They take it straight away. That's the mistake that you should not do. Because when you are taking the hedging period might be for 3 months or 4 months or 6 months. I don't know. Depends on the case study. They will not give you for annual year. They never give for annual year. They will give you for some months only. But the interest rate, whether it is investing, whether it is borrowing, it is given to you annual rate. So you have to time apportion this. The annual, I've highlighted annual also. The rate which they give, even though they say for 3-month rate, they are still taking the annual rate only. That annual rate for 3 months they are telling. But you need to find out the 3 month or 4 month like that, whatever, depending on the hedging period. Okay. Whether for both investing and borrowing, you have to do the same thing. If you see the questions on money market hedging, you will see this pattern. The table that I have used here, they follow this order only, same way only. The time apportion investing and borrowing, invest, convert, borrow. For receipt, borrow, convert, invest. Okay, that's it for money market hedging. Now, coming to the advantages and disadvantages, because I told every hedging techniques when you are studying, know the advantages and disadvantages. Not in fact only for this. Any model that you study in AFM, make sure that you know the advantages and disadvantages, even for valuation purposes also, in acquisition and merger. There are so many models, methods. You need to know the advantages and disadvantages, because knowing advantages and disadvantages helps you a lot to answer your theory part. Trust me on this. Even though you have to know some additional points, how to interpret your calculation answers and all, but advantages and disadvantages will help you a great way, you know, to give better answers. So advantage, one advantage is only there. What is it? What are we using? Investing and borrowing. So technically we are using the interest rate only of the two countries, isn't it? So when we are using the interest rate, what is it known? there's a term used for it where you're using the interest rate of the two countries to predict an exchange rate. Interest rate parity. Interest rate parity. It is known as interest rate parity. So interest rate parity implies that money market hedge should give the same result as the forward contract, because we know that there is a interest rate parity. That means the difference between the two interest rate is equal to the forward rate. Okay. So because it's forward equal to, so money market hedge is based on interest rate parity. So that means money market hedge should give you the same result as forward contract, right? And this can be used for some currencies where forward contracts are not available. You can see, we know from our before slide under forward, disadvantages was availability of forward. It's not available for all currencies. So wherever forward is not available, you can use money market hedging, because they will give you similar result, no? So it does not matter whether you use forward or money market hedging. Coming to the disadvantages, may be difficult to use if the firm has cash flow problem. Yes, cash flow problem, because money market is based upon cash only. You should have the cash also to borrow. You should have the cash also to invest, because this is about investing and borrowing, not about choosing the rate, unlike forward. So this is, if there's a difficulty in cash flow problem, you cannot use money market hedging. Second, that's it. Yeah, that's it. So one advantages and one disadvantage. Now let us go to the future contract, the third type of hedging instruments. Very common, very common. You will be getting future, don't worry. You cannot skip future. I have not seen a single question up to date in AFM where future, forward, okay, forward not always, but future and optioned income. If not in the currency risk, at least in the interest rate risk, they will ask you. One out of these two, you will get future contract and options. So let's start with the future. In future, what is it? Definition. Future contracts are forward contracts traded on a future and option exchange. Definitions you don't have to know, because no one is going to ask you the definition, and you don't have to write also the answers. You just have to know this is exchange traded, okay? This is not over the counter like forward. That means you have a standard size, you have a standard time at which you can take future contract. It's not available 24/7. It's not customized like forward, okay? And not all currencies have future contract. You do not have a future contract for all currencies. One example is dollar, right? You don't have a future on dollar, but in the exam they might give you a futures on dollar, because they might assume that is an over the counter future. Imaginary things they might give you, but in reality we don't have such things like futures on dollar. Second, it is assumed that the contract matches at the end of the month. This you should know whenever you are given. For example, you are given the future contracts for, usually for this month, March, June, September, and December. We call it March future, June future, September future, December future, right? So when we are taking those future, it will always mature at the end of the month. That means if you are taking a June future, it will expire on 30th of June. If you are taking a September, 30th of September. If you are taking December, 31st of December. It's like that. Okay. Even if this assumption is not there, that is the default assumption. Okay. Range of available futures limited is a disadvantage. You don't have a wide variety of future. No. Only some currencies have future. And there's a fixed contract size also. So it's limited. The market is limited. Exam questions gives the contract size. Remember, exam question will always give you the contract size. So you don't have to worry about it. The fixed contract size, okay? And one good thing, if you learn future first and then go to options, because if you study future, you will understand options automatically. The only additional thing in option is you have to calculate premium, number one. Number two, that put or call. In future, question is buy or sell. In option, call or put. And premium, additional premium, we have to calculate in option, which is not there in future. These are the differences. That's it. Now, the lock-in rate. What is this rate? In future, very important for your exam. That's why it's in bold. Sometimes you have to think also why some things I have highlighted or something is in bold. There's a reason for that, because it's very important. When something is very important, I highlight it or I bold. I make it bold so that you can see, which is lock-in rate. This rate you have to calculate up to date. There is no single question where you didn't have to calculate. You have to calculate. Lock-in rate. What is lock-in rate? Another word for lock-in rate is closing future price. They will never give you the closing future price. The price which they give you for future is the opening future price. So you have to calculate the closing future price, because after you calculate the closing future price only you'll be able to calculate gain or loss on the future. For option and future, you have to calculate the gain or loss. You need it. Hence, you need to calculate closing future price. So what is the formula? This is the formula. Memorize it and keep it. Because I have been getting a question recently on YouTube. In fact, I got many questions in the comment section. Students have been asking me, how do you know whether when you have to add or when you have to deduct, or why there's a deduction when you had to add the basis. The reason is that basis that you have calculated is negative figure, right? No one says you that you should always get a positive basis. You might get a negative basis also. So in that case, it's a minus, because when you add a negative number with a positive number, it automatically is deducted. If you're getting a confusion, what you can do is keep it plus only under both the conditions, whether positive or negative basis. Plus, let's say your basis is minus 5. Okay, so plus opening future price plus minus 5. Okay, you can put that minus 5 in a calculator and check. You will get a minus. Now automatically plus minus means it's a minus only, so that 5 will be deducted only from the opening future price. So in the exam they don't tell you this in the solution. That's the reason students get confused. I think they should make it more clear, the examiner. But it's okay. Now that you know, so you will not make this mistake. Okay, I believe you will not make this mistake. Okay, so it's automatically deducted only. So the easiest way, if it's plus you add, if it's negative you deduct. Simple. With the opening future price, because basis could be positive or negative. Okay, opening future price is given, basis you have to calculate. Okay, that means your basis also have to be correct for your closing future price to be correct, because everything depends on your closing future price. But don't worry, don't panic if your closing future price you get it wrong, you come to realize later it's wrong. Don't worry, don't panic. There is always a way out to get marks. You will only lose 1 mark for getting an incorrect closing future price, but remember, majority of the marks lies in your calculation of working. You must have done working to calculate that basis risk. So for that you will get the marks. Okay, now let us go to step. These are some steps. Okay, 3 steps that you need to know when it comes to calculation of future. Any questions on future, this is the basic step that you need to follow. Step 1 will always be, you need to set up the head by addressing 3 key questions. You start with this: do we initially buy or sell future? This is a key question. You always start your future with this only. Future questions. You buy future or you sell future. How do you know this? Well, you look at the contract size. It is in which currency? Okay. For example, if it's a payment, we usually buy when it's a foreign payment. Okay, when it's a foreign payment we buy, when it's a foreign receipt we sell future. But currency also matters a lot. Sometimes your foreign currency might be different to the contract size. In that case you need to reverse this decision. One example, let's say your foreign payment, it's a payment, your foreign payment is in pounds, UK pounds. UK pound is a foreign currency. Okay, but your contract size is in dollar, let's assume. So now you cannot say because it's a payment by future, no, you cannot say by future. Normal way by future only, but look at the currency of the contract is different to your foreign currency. Foreign payment is in pounds, future is the contract size is in dollar. So that means you can either buy dollar or sell dollar. You cannot do anything with pounds. So it does not matter what currency your payment or receipt is. Look at the contract size. If the contract size is in dollar, what are you going to do with the dollar? That matters. So now you have to do one additional step. First, you have to think about what is it? Pounds, because your payment is in pounds. So normal way you do add this additional step when your contract size is different from your foreign currency. If it's the same, then normal way you buy future. You buy pound future because contract size is in pounds, your payment is in pounds, so buy pounds. It's easy because payment you buy, receipt you sell. But if contract size and payment or receipt is different, then only this step comes. This confusion comes. Okay. So what do you do when it's a payment is a pound? You buy pound. Okay, you buy pound, but contract size is in dollar, so you reverse it. Buy pound, sell dollar. Buy pound, sell dollar. It's like that. Okay, so it goes like that only. When you buy pound means you are selling dollar. So you're selling dollar means you are selling future. Selling dollar future. That's it. Decision solved. This is your decision. You have solved it. So you start like that. You start with pounds and then you convert into dollar. Buy dollar. Sorry. Buy pounds. Sell dollar. Sell dollar. Buy pounds. Okay. It's always the opposite in different currencies. If you are buying in one currency, remember you are selling in another currency. It cannot be that you are buying in pounds and you are buying in dollar. No. You are selling in dollar to get that pounds because you want to buy pounds. Okay. Step 2. How many contract? Very easy. What is the contracts? What is the amount that you want to hedge? And the contract size. So divide the amount that you want to hedge simply by the contract size to get the number of contract. But there is a problem with this. You need to take extra care here also. Your amount that you want to hedge, whether it's a payment or receipt, and the contract size needs to be in same currency. Otherwise, you cannot divide because there is a rule when you have to divide, it has to be in same unit, same currency, same interest, whatever, everything. It has to be in same. You cannot divide two different currencies. You can never do that. Sometimes it happens that the payment, your foreign payment, I'm going to give examples for payment only, okay? From here onwards for everything. So you can apply it for the receipt is the opposite. Okay, I hope you will be able to understand, because if I try to explain both the ways you will get more confused. So better you do it through questions and know it. But if I tell for payment, make sure that for receipt is the opposite. Okay, from here onwards, men, for option swap I'm going to use the same example. That's the reason I'm telling you before. So let's say it's a foreign payment. Okay, because payment is easier to explain. Also students understand payment more than receipt, because mostly we get payment only in the question, so that's why we are more comfortable with payments, but it's okay, whatever you feel comfortable. Okay, so payment, for example, you are having a foreign payment of 1.5 million pounds, but your contract size is in dollar. You see, so it's in two different currency. You cannot divide and find the number of contract. In that condition, what should you do? You should do one additional step: convert. Convert what? Convert the contract size? No way. You never convert the contract size. Contract size keep as it is. If the contract size is, let's say, 200,000, contract size will be 200,000 only. Then what are you changing there? Change the amount that you have to hedge your foreign payment. You are changing the currency of that foreign payment. Your foreign payment was in pounds, so you change it into dollar because your contract size is in dollar. So make everything to the contract size in that currency. Whatever the currency of your contract size, bring everything to that currency. Hence, your foreign payment, you are converting it into dollar. How are you converting it into dollar? Using the rate given to you. You have the rate, no? Spot rate. Spot rate is given to you. So using the spot rate, convert. Okay. Once it is converted, then now you can divide. So let's say 1.5 million pounds you have converted into dollar. Once you have converted into dollar, it's a dollar payment. So dollar payment divided by dollar contract size, you will be getting the number of contracts. What happens if both are same? Contract size is also in dollar, the amount that you want to hedge, your foreign payment is also in dollar, then simply divide. No need to convert or do anything because both are in same currency. Divide and find the number of contract. Okay. So number of contracts also, sometimes you might get a whole number. If you are getting a whole number, let's say you have divided 1000 by 20, you'll be getting a whole number, right? A full number. That's a good thing. If you're getting a full number, calculations becomes easier also. When you're getting a whole number, that means a round up figure, no decimal. That means there is no under or over hedging. You have perfectly hedged. There's a perfect hedging. You have entirely hedged the whole amount. The problem comes And most of the time, even in your exam also, what does the examiner do? They will never make your life easier. They will always try to give you something which you don't expect, you don't want. They know that you love round up figures and all, but they will not give you that. Don't worry. They will make sure that you get number which are decimal, right? But I'm not saying you will 100% get that also. You might sometimes get easy ones also. But let's just assume the harder ones so that you practice more and more and more. So they will give you the roundup figure. Sorry, they will give you where you are getting decimal number of contract. Let's say 76.2, 76.3, 76.5. Then what to do? That means you have to round down, not round up, round down. Even if you are getting 76.7. Sometimes in the book, if you see textbook and all, you must have seen that they have rounded up, but that's wrong. Okay, even we have taken it like that initially, but let us just revise that. That we are going to round down no matter what happens, not round up. So we are going to round down 76.2, 76 contract, 76.5, 76 contract. Okay. So we are going to round down 76 contract. That means we are taking lesser contract. So since we are taking lesser contract, means some amount will remain unhedged, right? So how are we going to deal with that? That amount now we have to hedge using forward. Understood? Using what? Forward. You will be, if forward is given to you. Okay. Otherwise, you can just write that note that the balance can be hedged. Sometimes you might not have to show calculations for that unhedged. That's also acceptable in the answer. Okay, sometimes you have to show, but you will be getting marks for both the this thing. Whether you show that additional hedging using forward or you don't show it, you will get marks. But I prefer better to show the amount that you'll be hedging using forward if forward is given to you. Okay, the unhedged amount. Because you cannot just keep it now like that. You somehow try, you have to hedge it using some other method, if not future then forward. And forward only, not any other market. Okay, they might give you options on money market hedging, and now don't come and ask me why not other methods, why are they not hedging the unhedged amount using other methods. No, forward only, because forward is the easiest. Why would you go for options taking premiums and all, high premium, just to hedge the small amount of unhedged amount? It's not worth it. And money market hedging is not always asked. Okay, it's forward and options and future only. So take the forward only. Okay, so you will get the number of contracts, and number of contracts you need for both interest rate risk management as well as currency risk management. Okay, make sure, if you see that I'm always referring to interest rate risk also, the reason is because when I will tomorrow I will explain you interest rate risk management, things will become easier for you. You know that this is just a repetition. I don't want to repeat. It will save your time as well as mine. Rather than repeating same things, I'm explaining here only the differences. So here also you have to calculate number of contracts, there also you have to calculate number of contracts, but there's difference. Small difference is there. You have to calculate a fraction over there in the interest rate risk management, not here. That I will explain tomorrow when I actually explain you the interest rate risk management. Here, if I explain, it will be too early for you and you will get confused also. Okay, because you need some figure in front of you to see how. Next, which expiry date should be chosen? Third question. That means March future, June future, September future. It depends on the time that you want to hedge for. For example, today your day, they will give you the date today. Today is, let's say, 1st of March. You want to hedge for 3 months. So March, April, May. So what is the closest future that you are going to take? Which is closest to May? June future. March you cannot take because March is expired, because you want to hedge for 3 months. So you'll be using the closest to it. Remember, always the closest. So June future, yeah, the next closest is June, because March, April, May. So June. After the closing of the hedging period is June, after 3 months. So you are going to take June future. Okay. Now, step 2. So these are the 3 questions that you need to ask in future. Any future question. Step 1. It's always followed. Step 2. Pay the initial margin. See, step 2 is not asked usually. Okay. But wherever you are given some margins and all, initial margin, maintenance margin, variation margin, you have to pay some initial margin. They will give you the amount of the margin. Okay. That you have to pay in step 2. Step 3. Calculate profit or loss in the future market. How? Closing out the future contract. What did you do in step 1? You opened up a future position. Step 3, now you're closing that future position. So for example, let's say in step 1 you are buying future. So how are you going to close it? By selling. You buy, you sell, you sell, you buy. That's how you close the future. If you're buying initially, you sell later. If you sell initially, you buy later. So let's say you're buying initially. That means you have to sell in step 3 to close out the future. So that difference between buying and selling is your profit or loss. If your selling is more than buy, it's a profit. If your selling is less than your buying, it's a loss. Okay, it's easy. Selling has to be more than buying. So profit or loss, that's how you calculate profit or loss in the future. And that's not enough. Calculating profit or loss in the future. Calculate the value of transaction using the spot rate on the transaction date. So the value of the transaction, okay, whatever is there. Let's say 1.5 million US dollar you have to hedge. That was your payment. So now you have to convert that using spot rate and add. If it's a profit, you add. If it's a loss, you deduct. So you compare this with your profit or loss. You add or deduct with your profit or loss the amount that you get after converting using a spot rate, and the net amount is only your answer, the amount that you will receive or pay after hedging. That's it for future. Okay, and if you want to see questions, I have already done questions on future options and swaps and all. You can check out in my playlist and risk management, AFM risk management lecture. There you will get this, all the topics: future options, swap, interest rate option, interest rate future, all those things. Those questions and numbers I'm not going to do here. I'm not going to show you the numbers here. Okay, the purpose of this video is, this is just a quick revision. I'm just telling you the methods that you need to know. Okay, this is not a detailed explanation of anything or calculation. Now let us go to currency option. So understood future, now let us go to option. Option. Option means it's not an obligation, it's a right. You might exercise, you might not exercise. You have the freedom of choice. Option. You can either buy the currency or sell the currency at a future date. Option. Whether you exercise or not, it's up to you. Then that's a definition. So the disadvantage of option is options are more expensive than forward or money. Sorry, forward or future. Why? Because there's a flexibility in option, which only option gives you, not any other hedging techniques. That's the advantage of option. What is it? So for that advantage, you have to pay more. Increase flexibility. There's a flexibility. What is the flexibility? You might exercise if the favorable rate goes against your favor. If you might not exercise if the favorable rate goes in your favor. So you see, in both ways you are getting the advantage. If the favorable goes against your predictions, you are exercising. Hence you want to hedge. You want to minimize the risk because favorable rate is not going in your direction, in your favor. What happens if it's the other way around? Exchange rates are going in your favor, in the right direction. That means what? Then you do not exercise the option. You let the option lapse. You will get the benefit of that increase in exchange rate. That benefit you will be receiving under options only. So for that, you have to pay higher premium because nothing comes free of cost. The higher the advantage you have, more you have to pay for. More you have to pay for that advantage, which is not there in forward, future, or options. Sorry, or money market. Not any other hedging techniques has this option, which option has. Okay, they can take advantage of both the side. Downside also, they can minimize the risk by hedging. Upside also, they can take the advantage. But forward, what did we see in forward? It locked the rate in one rate. If it reduces, sorry, if exchange rate goes unfavorable, that means exchange rate is unfavorable, you hedge. You hedge the risk. If it goes in favor, you cannot take the benefit because one lock is rate. Future is also like that. Okay. If you take the future, if you're having a gain in future, remember, in the spot market you'll be having a loss. If you're having a gain in the spot market, in the future you'll be having a loss. It's opposite. So that it offsets, offset, right? The opposite from one market and the loss from another market offsets each other. Hence overall impact is reduced. The overall risk is reduced. Option is not like that. Option, downward Okay, hedge. Upward if it goes, take the advantage by not exercising the option. Next, currency options can be both. It could be over the counter as well as exchange traded options. Okay, they will tell you in the question what type it is usually. But whatever type it is, calculation remains the same, whether it's over the whether it is exchange traded. So here also we have the same similar steps to future. Okay, we have 4 steps. Step 1, 4 key questions here you need to ask. In future we have 3. So question number 1, same. In future, question was, do we need to buy or sell? That means short or long on future. When it comes to option, the term changes to call or put. Do we need call or put option? So here also, if it's a foreign payment, it's a put option. Remember this. Borrowing, put option. Borrowing receipt, call option. But remember, when we are saying that, again, like future, it has to be in the same currency. For long and call, for deciding that your contract size and your hedging amount has to be in the same currency, here also it has to be in the same currency. The amount that you have to hedge versus your contract size. And contract size is always the same as the future. There is no separate contract size for option and separate for future, no. So that's one good thing. Okay, if the contract size is in dollar, the foreign payment is in dollar, then for foreign payment, put option, foreign receipt, call option, normal way. But if it's in different currency, then you have to reverse it. Then for foreign payment, it will be a call option. For foreign receipt, it will be a put option. Okay, so check the currencies, the contract size versus the amount that you have to hedge. Check this 2 currency, whether they are different or same. Then your call and put will change. How many contracts? Same to put future options, and mostly these 2 are same because the contract size is same, the amount that you have to hedge is same for options and future, right? So contract size is also no need to calculate again. Whatever you have calculated for future, as it is, you can copy paste in the cell. Okay, now which expiry date? Here also, like future, we have March option, June option, September option, December option. If it's over the counter, they might give you different dates also. There also you have to choose. Same way how we have done for future, here also same way we have to choose the expiry date. Another question. Which exercise price or strike price? It's same. Strike or exercise should be used. Usually they will give you in the exam, so you don't have to worry about it. Okay, they give you the exercise price. If they don't give you exercise price, if they are giving you the 2 exercise prices, remember, you need to calculate under both exercise price and then decide, are you going to exercise or you're not going to exercise. If they give you 2 exchange rates and they don't tell you which exchange rates to use, but normally what I have seen in the past paper, they give you the exchange rates, sorry, they give you the exercise price, they tell you that this is the exercise price. So that's one way, a good thing, saves your time. But if it's not, if they are giving 2 exercise price, calculate under both and then decide exercise or not exercise. More than 2 they will not give you, they will not give you to calculate more than 2, right? It should not be that under 3 different exercise price you are calculating. No, they will not make things that complex also. So it's 1 or 2. 1 it is fixed, 2 then you have to decide. But no, normally what I have seen is 1 exercise price only they give you. Okay, and here also when you're finding how many contract, you might have options, sorry, you might have infraction. So if you're having infraction, you can convert it using forward. Okay, if you're having whole number, then no need to, then there's no unhedged overhedged, same amount is been hedged. So here also when you're finding number of contract, like in future, you have to see the contract size versus the amount that you have to hedge. If they're in same currency, you can divide and find the number of contracts. But if they are not in same currency, you have to first convert the amount that you have to hedge to the currency of the contract. How are you going to convert it? There we use stock price, but here exercise price. Exercise price you have to use, not the spot rate, to convert it. Why? Because when we take options, whether we exercise it or not, conversion rate should be the exercise price only. Okay, not the spot rate. Step 2, pay the upfront fee. Remember, premium sometimes you might have to convert, it depends. But premium at the end has to be in your home currency only. Okay, everything whatever you're doing, whether options, swap, future, forward, at the end what is the final answer? In your currency only, home currency only. What is the receipt in your currency? What is the payment in your currency? That only you are comparing with other hedging techniques and telling that this is the best or this is the best. Okay, so premium also can be in a different currency. So premium also have to make sure that it is in your currency before you actually deduct premium if it's a payment. Okay, so when you are converting premium, remember sometimes you might have to convert premium. Sometimes as it is you can take the premium. Maybe the currency is already given. So if for the premium, okay, you might have to convert. What rate are you using for premium? Not exercise price, not exercise price, spot rate. For premium, we are not using exercise price. Why spot rate? See, premium, irrespective of whether we exercise or not, does not matter. We still have to pay the premium. That's why we have to use the spot rate, the opening rate. The rate that you have chosen for your forward rate, call or bet. That is the spot rate. From there, you have to take for premium. So since premium is a payment, accordingly you have to decide which rate, bid rate or ask rate for premium. Because it's a payment and check the currency also. Okay. Step 3. Compare the option price with the prevailing spot rate. Same how we have done for future. Here also the option gain or loss you have to compare with the spot rate transactions. Okay, converting the transaction into using spot rate, you compare and then that net amount is your payment or receipt. Because when we compare the option price to the spot rate, you can decide whether you can exercise the option or not. Okay, option price means what? Exercise price. Exercise price. Okay, spot rate, they will give you the spot rate. So what is the prevailing spot rate? Now if you see the prevailing spot rate, you have to understand this because this is taken from the future only. Okay, that's why do first future then options. Even in your exam also, make this a habit. Because a lot of things from future you have to take for options. Okay, and our future is much easier than options. Also, option we have to calculate additional things like whether we exercise or not, then premium and all those things. In future is not needed. So that prevailing spot rate is usually the what? The which future price, opening or closing? Closing future price. Yes, closing future price. Now do you understand why from there onwards you have to be correct? That means closing future price, when you're calculating under future, you have to be correct there because you need this in the future. Sorry, options. You are replacing this in the spot rate and comparing that closing future price with the exercise price and seeing whether you are going to exercise or not. For example, if it's a payment call option, you want to pay at a higher amount. Sorry, you want to pay at a lower amount. So if your exercise price is less than your closing future price, definitely you will exercise the option if it's a call option, opposite for put. Okay, so this is how you decide. Step 4. Calculate the net cash flow. Here also be careful if your number of the contract needs rounding, like for future. Okay, then the amount that is not being hedged will be hedged using spot rate. Okay, even if the option is exercised, you might say why can't we hedge everything under options? No, because we have used a lesser contract than what is actually required because of decimals and all. So we have round down. That's why we need to use spot rate. Okay. Here also calculate net cash flows. It could be a receipt, it could be a payment. But it will be in your home currency only, local currency, after you have converted from foreign currency. Now let us go to two types of swap. One is foreign exchange swap, the other one is currency swap. What is foreign exchange swap? And these two are different, by the way. That's the reason they have been given as a separate topic. Otherwise, they would have been given one swap only. So what is forex swap? Swap means what? You swap. For example, you swap your phone with your friend. That means you are taking your friend's phone for a day and your friend is taking your phone for a day. And at the end later, you'll be returning them back to each other. This is known as swap. So in foreign exchange also same way we can swap with each other. Okay, what are we exchanging here? We are exchanging cash flows. We are exchanging cash flow that is relating for a specific obligations that we have to pay in the future. Okay, and that also for a agreed period of time. For example, it's a payment, foreign payment that you have to make in 3 months time. So for those 3 months time you're exchanging, you're swapping with each other the cash flows relating to that. Now number 2, swapping agreed equivalent amount of currency at an agreed rate for an agreed period. Okay, rate will be agreed and for agreed period. Okay, you are swapping the equivalent amount of currency. Third, so this is mostly called as fixed for fixed. Okay, fixed rate for fixed rate swap. That means, let's say the foreign exchange, you're using the swap. So fixed rate. Okay, let's say you are using one fixed rate. Both are in fixed rate only. Okay, for the currency. So you are using one fixed rate, counterparty, the second party is using another fixed rate. So both of you might change your fixed rate with each other. You might pay their fixed rate, they might pay your fixed rate. So that's why it is known as fixed for fixed. Okay, fixed rate swap. Now, allows hedging for potentially longer periods than forward. Yes, swap usually allows you to hedge more than forward contract, right? That's the advantage of foreign swap. Then another advantage is useful for where there are exchange controls or volatile exchange rates. How? Don't just memorize. See, advantages and disadvantages of features when you're studying of any model. Make sure that you are able to link. You are able to logically understand also how this is an advantage, how this is an advantage. Don't just memorize. Okay. These are 5 advantages, 4 disadvantages. No, don't memorize it like this. It will not help you in the long term. Trust me. Things become very boring also. How much can you pressurize and how much can you remember? This is one paper. As you just imagine, you have to give two papers, two P-level papers you are giving, and you are memorizing all these advantages and disadvantages. So don't do this. Okay, please have mercy on yourself and let you relax. Okay, calm down. Don't stress yourself. Don't overdo things. So just understanding is enough. Automatically, when you come to write now, you will get enough points to write because you have read it several times, the advantages and disadvantages. So now it's there in your subconscious mind. It just comes out when you're there in that exam hall. You just think that you're forgetting, and not remembering. It happens to me. It happens to everyone. We all are humans. It's a natural tendency that it happens that you keep on forgetting or you think that you're forgetting everything. Oh shit, it's just that you're in that mode. But trust me, when you go to that exam hall you will remember. Okay, when you actually come to write the answer you'll be thinking and point will automatically come to you. Make sure that you just have a good understanding, that's it, so that then you can be flexible enough to change the words and write. Otherwise if you just memorize and go, no, what happens at the end, either you don't remember, even if you remember you might have wrote some wrong words which does not make any sense because you didn't understand the meaning behind it. You were just memorizing the word by word. Okay, memorizing is good if you have understood it. Some word, maybe a keyword you can memorize, but not the whole sentence as it is. No one can do that unless you are some alien or you say came from some other world or something and you have some power to remember word by word. Okay, but for other people, please save yourself by not torturing yourself to remember too much. So exchange control, when you're having, it's hard to use other rate. Why? For forward rate you cannot use, because when exchange rates are so volatile, even if you're using forward, let's say, but if the exchange rate goes in your favor and very hugely, that means a huge amount of gain you are losing. You cannot take the advantage. So it's not useful for you. Same way for option. You take the option, options are very expensive, especially when there are volatile exchange rates and all. It might go favorably, and the difference might be too much. That means you let the option lapse. Even if you let the option lapse, the premium that you had to pay was too high. So option is also not useful in this condition when exchange rates are volatile. When exchange rates are stable, yes, you can use for forward and all, because the amount that you have to hedge is very little. Exchange is volatile means you don't know which direction it can go, but whatever direction it goes is not stable. Keeps on changing, keeps on changing. Next, what was this? So these are the few techniques, and even for money market hedge also this is not a suitable method when exchange rates are volatile. Why? Because money market you are using based on cash flows. You should have enough cash flows also. If you're having a volatile exchange rates, you will be having a volatile cash flows also. So that's not a good method again. So you see, out of all, foreign exchange swap is the best, because even if you're having a volatile exchanges, you can just swap your fixed rate with their fixed rate. You have to pay their fixed rate. not yours if it's a volatile exchange. So this is a better, useful. Not the best, but useful compared to other methods. Currency swap. Coming to currency swap. Currency swap means you are swapping of interest rate commitment. Okay. You are just converting what? Swapping interest rate. Remember, you have to pay the interest on borrowing. When you're borrowing in different currencies, you have to pay the interest rate, right? So for that interest rate, you are swapping that only on that borrowing. And it includes both swap as well as reswap of principal and an exchange of interest rate. Because when you are taking a borrowing, you have to pay two things. No, one is principal, one is interest rate. So principal, also you might swap the principal amount, the amount of the loan or the borrowing, or the interest on that you might swap. Next. So swap of interest rates could be, this is swap of interest rate, okay? Fix for fix or fix for variable. You could check fix for fix. Maybe you are using different rate. You're borrowing for that currency in a different rate. Maybe in your currency you are borrowing in fix. Let's say you're having two currencies, okay? Dollar and pounds. And for dollar the fixed rate is something else. For pound the fixed rate is something else. But both are fixed rate only. Now you're swapping with each other. Your own currency was dollar, but now you are paying the pound interest rate in pounds currency, for the pounds currency which is fixed, and they are paying for your currency which is dollar, that is also fixed. So that's known as fixed for fixed. Next type of swap could be fixed for variable. What does it mean? That means you are paying, that means your currency is having fixed, their currency is having variable. So what do you do? Now you will take their variable and they will take your fixed rate. You both are having different rates. One is having on a fixed rate, one is having on a variable rate. So that's the difference. It could be fixed for fixed or fixed for variable on different currencies. But remember, this is different compared to your interest rate swap. How? This fix for fix means not the interest rate. I mean, it's the interest rate, but it is on different currencies, two currencies. Fixed rate on dollar currencies versus fixed rates on pound currency. It's like that. Fixed for variable means fixed on dollar currency versus variable on pound currency. It's like that. Currencies are different. Okay, so rate might be same in different two different currencies, or rate might be different in two different currencies. You see, but interest rate swap is not like that. Interest rate swap, same currency, only one currency is there. Currency does not change, only the rate changes. Interest rate fixed. Okay, you might take fixed for variable, and there we don't have fixed for fix. There we have fixed for variable only in interest rate swap. Tomorrow, which we are going to cover in day 11 tomorrow. Okay. Calculation is not required. Calculation is not given in currency swap from currency point of view, but in the interest rate swap there is a whole long table that you need to follow. Inshallah we will be following it tomorrow, because many people have a doubt in that area. Some areas are always doubtful. One is options, sorry, one is collar, one is interest rate swap. So this few areas are always very doubtful areas, very tricky areas to cover. So when you're studying also, be a little more alert and pay more careful attention to these areas, because these are the areas, once you understand it, you can score maximum marks, even though they are the toughest. Because toughest area are the areas where examiner makes it easy for you. Remember that this always. Easy areas they can easily manipulate and give make it more harder for you. And you in your overconfident can easily make mistakes, thinking that I've done the right thing. Trust me, I'm telling from experience. I've seen my own friends doing the same mistakes. They become overconfident. They are like, I have learned everything, every possible questions I have done. But in the exam, when they come, they're like, what is this? I mean, they've never seen that question, or most of them, they are not able to finish it on time. That's the main reason why people fail in AFM. Let me tell you this, especially when this type of question comes: interest rate swap, interest rate collar, because they're not prepared. They prepare in other areas well, like net present value or normal option future, but not in these areas. So time management is an issue there, because if you don't practice this, you will be lacking behind time also. You, because you think it's very tough, that means more calculations are required. So no, it's not true. Okay. In fact, the hardest are easier, because The thing is, it's not flexible also. They can only ask one type of questions. For interest rate swap, have you seen different questions? Only one type of question comes. Which rate are you taking? What is the gain after swap? What is the net position? That's it. Who is going to receive what? Who is going to pay what? That's it. Same table every time it is followed. Coming for caller also. What's happening with the caller? What is the net position? That's it. Same type of question only they can ask. They can not change this question into any other area. So that's a good thing. If you learn this area, if you crack this area, you are going to secure high marks for AFM, trust me, because you anyway know the basic things, you have a good understanding on it. Now studying more complex things will give you a bonus additional marks above 50. Maybe you can get 60, 70, 80, there's no limit to that upper level. So for further reading, you can read on your ACCA website known as article known as currency swap, and I encourage every one of you to read it, because currency swap is a not an area which is always asked, and I didn't see any question also. If you see the past paper, we didn't see, right? No question was there, so make sure that you read this. You never know, it might come in your exam. Now let us go to the last, which is the internal hedging technique, which is bilateral and multilateral. Bilateral means one to one, you are netting one to one. Multilateral means many subsidiaries are there. Okay, so you have to follow this table. Okay, mostly it is multilateral netting which is asked in AFM. Okay, so whenever multilateral netting is given, follow this method, tabular method. Tabular method means you have to make a form of a table, like where you will be having columns and rows. Okay, so step one, set up a table with the name of each company down the side and across the top. That means you have to write the name of the company twice. Once you are writing horizontally, the other time you are writing it vertically. Okay, because you might be paying to someone else and that someone else also might be paying to you. So you have to write across also, and horizontally also as well as vertically also, across and as well as down. Okay, step number one. Step number two, and company name is given to you, who is owing to whom. Okay, this company is owing to this company, so you know who is owed and who is owed to and who is owed by, both you know. So those companies only you have to write. Step two, okay, write all the amount that they are owing as it is from the question you are taking from your scenario case study. Okay, and you have to do this in Excel. Make sure that you do it very quickly. Okay, make sure you practice now itself. You have few days left. Practice this on your Excel today, the tabular method. So amount owing and amount owed to. Write the amount in whatever currency they have given to you. Don't convert now. Write it across as well as vertically. After that, okay, you have to write it across. Okay, another column at the end after writing the name of the company across as well as downside. One column will be for receiving company, the other one will be for the payment company. Okay, so you need to convert. Okay, after you have put the payment and the receipt, who is going to whom and who is receiving from whom, in the currency that is given, you have to convert into one currency. Everything needs to be converted into one base currency. They will give you the currency, they will give you the rate also, at what rate to convert. Sometimes you might be having 3 4 currencies, so the different rate exchange rate they might give you, right? They will give you the rates, different rates, and what currency you need to convert, that also they will tell you. For example, they will tell you that everything needs to be settled in dollar, everything needs to be netted off in dollar, so convert everything in dollar. And some currencies might already be given to you in dollar, so those things you don't have to convert back, you can just take as it is. The amounts which is not in dollar, you have to convert into dollar. Okay, don't go to the exam and write everything in dollar if dollar is not asked. This is just an example I'm giving you. Through examples I'm telling you. After you convert only, then step 3, add across and down the table. So first you are writing who is owing to whom, then you are converting, then step 3 you are adding. Now you are adding two side, one you are adding across, the other one is you are adding downside. Okay, adding across. Okay, I don't know whether it is across or downside, which company is paying or receiving. Okay, Definitely one side will be, let's say the vertical side is the paying side and the horizontal side is the receivable side. Okay, so add both the columns and then simply deduct your payment from the receipt and write your net payment or net receivable position at the last column towards the right. Easily you can do it in Excel. You just have to compute, just add sum, add everything is easy to drag and put a sum function and write add all, right? Remember, you will be getting one mark for each. One mark for writing, one mark for converting it. Second mark for writing the net payable or receivable. You will be getting the marks. So for writing the net payment or receivable. After that, convert back into the original currency. Okay. Usually you don't have to convert back into the original currency if they tell you so. Otherwise, the net payment or receivable, you can leave it, and then what you have to do is you need to say who is paying to whom and who is receiving to whom. If you see, the effect of multilateral netting is they will bring so many 4, 5, 6, 7, 8 transactions down to 2 or 3 transactions. Okay, so the amount, the company who is having, let's say two companies are having in negative, in bracket, the balance is in bracket, that means net payment. One company is having a receipt. So how are you going to write the net position? The one who is in bracket, he has to pay the one who is having the receipt. Okay, understand? Let's say two companies are having payment, so those two companies will be paying to whom? Will be paying to the receiving company. And always make sure one thing, whether you are adding payment or receipt, this is very easy in Excel. Your receipt has to be equal to your payable. Okay, because whatever you're receiving, paying only you have is received by another company, right? Same thing. So receivable is equal to payable, it has to be equal. First check that before writing the net position or anything like that. Okay, and there are questions, 2 3 questions on this multilateral netting also. Make sure that you go through the format of this question in a CV platform. But and further reading for multilateral netting is on your ACC website, only technical article, exchange traded foreign exchange derivatives, because this is, first of all, it is exchange traded and it is a foreign exchange derivative. There's a multilateral netting and also you will get it there. It's a really recent article, so make sure you read it. So that's it for today. And if you see, this video is usually longer, right? It's longer than my all my other previous videos in AFM. So you can understand I have emphasized much on this video. I have focused much attention, stressed on certain things more and more, so that you know that these things are very important and you practice on this area and you make it, okay, and you go through this in detail. And please make sure that you go through the technical articles also. So tomorrow, day 11, we are going to cover hedging interest rate risk. So see you tomorrow and best of luck.